A warm welcome, everyone. Welcome to a new edition of Wolves Weekly. My guest today is Mr. Thomas Signer, a loyal and long-lasting faculty of SBS Swiss Business School with specialization of finance and accounting. And he has been teaching not only in SBS Zurich, but all over the world where SBS has different affiliated campuses. Thomas, welcome.
Thank you, Bert. It's very nice to be here.
So we'll talk about the topic which is your specialization, which is finance. But what I would like to talk about more in detail is the new normal in the financial world. And let me start by an opening question. I see that a lot of central banks are pumping money into the economy, not only in Switzerland, in the United States, almost everywhere in the world. And we know that this pumping of money into the economy, always it will take a generation to pay this back because states are increasing their debt levels. So do you think that this decision of central banks was a smart decision in the current COVID crisis environment?
Well, thank you. I think this question really cuts to the heart of the matter, which is that we have seen record money pumping into the economy, but we need to differentiate by the two actors doing so. Number one actor have been governments who have gone through the process in parliament, etc., to get approval to essentially support business by way of loans, by way of credit, etc., to avoid a situation of bankruptcies and layoffs. This has actually been well publicized and negotiated, and kind of gets my full backing. I feel it's a good thing that we here in Switzerland and elsewhere have made sure that not as many people lose their jobs as otherwise would. However, what has not received kind of the same attention outside of the finance world is what central banks have been doing. Mm-hmm. And this is really something our societies need to enter a debate into. The public process to get Congress to approve a $100 billion package or $1 trillion package is very cumbersome, but for the central banks, it basically takes a weekend to decide an amount of money which may be 10 times as much. So with the central bank actions, I think we have to disagree, and I'll happily get a bit more into that if.
Yeah, Thomas, because, I have two options. I can put my minimum amount of savings, which I have in a savings account in Switzerland. Probably I'll get negative interest rate. Or I can go to the stock market. And, at the end of the day, it's a little bit exaggerated what I will say, but it also contains a little bit of truth, is you can only be the winner. Because we already see today that Wall Street and Main Street are two different worlds. Yeah. And Wall Street, what are they doing? Stock market stocks are growing, and they're growing on the expectation, as far as my little understanding is, for two reasons. One, businesses everywhere in the world are opening again, bit by bit, Schritt für Schritt, bit by bit, but it's good because hopefully the customers are returning. So that's good because businesses can make money again. On the other hand, in case businesses are not opening properly and the customers are not coming, businesses are still the winner because the central banks are there and saying, we back you up, guys. So the only thing we can expect in the coming months is a growing stock markets all over the world. Or is that a wrong view?
No, that's essentially true. I'm 50 plus. I've been in the financial markets for 30 years plus, and I can say if there's one single lesson that we have learned, and some of us quite painfully, myself included early in my professional career, is that it is absolutely true that the determining factor for the stock market is the central bank balance sheet. The Fed makes the stock market. And everybody kind of still believing in a free capital market where demand and supply among private actors is deciding stock prices is unfortunately wrong. When I started my career in 1987, we had a crash in 1987. The Fed stepped in to make sure the stock price didn't fall too far, bailed everybody out. Then he was determined that he was, kind of program trading, new sort of program trading that was the culprit. In 2000, the culprit was, shady accounting in the technology sector. In 2008, the culprit was supposed to be the mortgage-backed securities. Whenever the stock market has signaled what the broad economy has been signaling for 30 years, which is that we are in a deflationary trend, in a disinflationary trend, which means prices are supposed to fall. Whenever the stock market wanted to realize that, the central banks have stepped in and said there is something wrong with the market. And I think now we have reached a point where the absurdity has reached new levels. Maybe just very briefly, because I'm following this quite closely, right? I have a bit of money in the market, and I'm glad I didn't get it wrong this time. But
well done, congratulations.
Thank you. Well, we had the situation already last year in September. We had 2000. We are still in a post-2008 crisis mode. Okay? We have never come out of this crisis because the Fed had continued to grow its balance sheet essentially until 2016. In 2017, they decided that they would try to normalize. I think this normalize is the term for our discussion here. So I think it deserves some attention. When they actually really started to reduce the balance sheet a tiny bit in 2018, we have seen that all asset classes returned negative returns in 2018. In January 2019, they reversed and said, there would be no more interest rate increases, and there would be no more shrinking of the balance sheet. In September 2019, we had an accident in the repo market, signaling already kind of lack of liquidity. And the Fed went in again, and it gave the green light to everybody to go long the stock market. So that's all we have learned. Never fight the Fed. Be long the stock market with low volatility. And then in February, we really had a situation where nobody was short. Everybody had been told that the Fed would sort of, increase it until April, when this coronavirus came in and, acted like a bomb and exposed the fragility in the financial system, that truly has been out there for a long time. And now, the course has been on March 3rd, the Fed cuts the rate, stock market doesn't react. March 15, they cut it to zero and announced that they will buy more treasury bonds and mortgage-backed securities. Market falls some more. And on March 23, they went all in with a real bazooka and said there's no limitation to the size of our balance sheet. And it has gone from something of less than 4 trillion to nearly 7 trillion in the meantime. And that has signaled to everyone, be long the stock market. But whether this is going to work, again, this time, I'm really not sure. What it's really destroying is capitalism as we teach it in schools, that there's something about fairness, about rewards for good behavior, punishment for bad behavior. That's been all thrown out, in this crisis. And that is what our societies need a discussion on.
Do you expect social unrest? Because I get scared when I understand you well. Basically, you're saying no matter what happens, if you have money in the stock market, don't panic, because always the Fed will come or any other central bank and help and save you. On the other hand, when I hear you, we need to have a discussion among our members of the society. I think post-COVID, we are going towards more tensions in the society, because you can. If I interpret correctly, what you're saying is, hey, Bert, the rich got richer and the poor people, they are getting poorer, and some of them even are having hunger every day.
Absolutely. And that is a terrible state that we have got into by central banks essentially not understanding the fundamental driving force between disinflation. and that is simple demographics. We are aging societies, we are naturally deflationary, and naturally deflationary force would also make stock prices go lower, but this they have fought tooth and nail and only postponed the problem into the future. So what it means for our students, Bert, what I very strongly feel about is really that we need to be clear. Our system is not going to last. Our savings are not secure. Our, monies that we think we will collect from the government when we baby boomers retire will not be there. This is a time for us to take care of our own fate, to look after our health, to look our wealth in terms of relationships and investments, and to really educate ourselves, to go for lifelong learning, to actually not strive ever to retire, but to know that we will basically have to work for as long as we can, and that our system is deeply, deeply unsafe. And, I wanted to go into this. We don't have the time of Chernobyl, because I feel what Corona is similar to is the Chernobyl accident, which hit a very weakened Soviet Union in 1986, which hastened collapse of that sick system 5 years later. And my view is we seem to be able to kind of, get through this one because interest rates remain low. People are still trusting in the system. Governments can still borrow endless amounts of money and, bail everybody out. But this financial system has a sell-by date, and it's not that far into the future as it would have been without the coronavirus.
Wow. I'm getting speechless. It says, I thought I was going to retire by 65. When I listen to you, I can throw that already in the garbage. I thought I'm going to have some savings for the next generation who are coming after me. It looks like this is not secure neither. And it looks like the state is not going to pay my pension. I'm getting scared when I listen to you.
It's fear, and fear is never a good advisor in life. The accomplishments that we have technology-wise, they're not going to disappear. So we have incredible technology that's going to be with us, but the kind of the world that we envisioned before, it's not going to be there. The basic issue is aging societies that will kind of see a drop in living standards. And what we do, which you highlighted, Bert, which I'm grateful for, is to basically say that the kind of help that we provide, or the central banks provide, bifurcate our societies more. They make the rich wealthier. Many of them don't want this, but they get this tailwind from the central bank, and some of the poor are totally left in the gutter, and that could lead to what you pointed to really social friction on a scale we have not seen since the 1930s.
Wow. Thomas, always interesting to listen to you, to chat and talk with you. I learned a lot again in our 10-15 minutes conversation, and probably you make me reflect now and actually let us finish like this, which is a reflection I do based upon this conversation. I think I'm going to invest more into my health because I'm a billionaire now, health-wise, and I would like to remain it. And I think that's also the key of your message. Thank you so much. Pleasure talking to you. And bleib gesund.
Yeah.
Stay healthy.
Same to you. Thank you so much. It was a pleasure.
Thank you. Bye.
Bye.